Hello everyone, and how are you all doing today? So today we're going to be doing yet another practice question for the ACCA Performance Management past paper. And the question we're doing today is from the December 2017 exam, Section C, question number 32. It's about a company called Sportsco, and the question is testing us on divisional performance measures such as the return on investment and residual income metrics. The reason I picked this question is because divisional performance measure questions are quite popular in Section C in recent sittings. And the good thing about this particular question is that it covers pretty much all aspects and types of questions you could get in Section C about the topic. So there's the calculation of ROI, there's the calculation of residual income, there's the analysis of ROI, there's the part for the advantages, disadvantages of residual income, right? So it's quite comprehensive in that sense, okay? So let's get into the question. Now, as always, we're gonna start by reading the requirement. So first part A, which has two parts. Part 1, calculate the return on investment for each of the two divisions of Sportsco for 6 marks, and then we have to discuss their performance based on that, right? So let's start by labeling our question. Question number 32. This is part A, and this is the first part of part A. Okay, so we have our labels. We'll make them bold to separate them and distinguish them from the rest of the answer and put them in a separate column. So 6 marks just for the calculation of the ROI. That's pretty good because generally speaking, ROI does not take too long to calculate. Okay. So before we go into the question itself, what was the formula of ROI? ROI was simply your controllable profit divided by your controllable capital employed, right? So let's just make a table for the calculation. We'll need our controllable profit and we'll need our controllable capital employed. But let's see what the calculation will entail, right? So Sportsco is a large manufacturing company specializing in the manufacture of a wide range of sports clothing and equipment. The company has 2 divisions, Division C and Division E. Each division operates with little intervention from the head office, and divisional managers have autonomy to make decisions about long-term investments. So why is this important? Because of the controllability aspect. The divisional managers are in charge of long-term investments, right? So they're in charge of the capital for the company. So we'll include that in the calculation. Okay. Sportsco measures the performance of its divisions using return on investment calculated using controllable profit. So they're telling us right here. And here's something important. Average divisional net assets. Net assets is basically another term you could say for capital employed. But average divisional net assets means that you need to take the average of the opening balance and the closing balance of capital employed, or in this case net assets, for the year. Okay. The target ROI is 18%, which will be used to assess the performance of the divisions. If the divisions meet or exceed this target, the managers receive a bonus. Okay. Last year, an investment was expected to meet the target ROI was rejected by one of the divisional managers because it would have reduced the division's overall ROI. So they're pretty much giving away what's happening and how the ROI was manipulated. Consequently, Sportsco is considering the introduction of a new performance measure, residual income, in order to discourage dysfunctional behavior in the future like ROI. This will be calculated using controllable profit and average divisional net assets, and the following operating statement has been prepared by a trainee accountant, and we're given all this data. Okay, so the top was more focused on the analysis, but it did tell us how to calculate the ROI based on controllable profit and divisional average divisional net assets. Okay, so average divisional net assets, that's a simpler calculation. We just have the numbers given here, so let's calculate that, then we'll make space for the controllable profit. So we have the opening net assets, we have the closing net assets, and we have the average net assets. Okay, and the best way to go about this is we'll make a heading for the table with the 2 divisions. So we have Division C. Remember to make the heading bold, italic, underline, something to distinguish it from the rest of the answer, right? So, and let's centralize this, so it'll be hard to tell given how wide the columns are. Okay, so opening net assets for Division C Now, mind you, this is all in thousands of dollars, so let's mention that as well for both of these. Okay, let's just centralize these. Okay, so opening is 13,000, closing is 9,000, and the average would be add these two together and divide by 2. Let's copy this here as well. So this will be 24,000 and 30,000. So the main thing the examiner will be looking for is these numbers, so we'll make them bold so that they stand out to the examiner, right? Now let's talk about the controllable profit, okay? We have the net profit given and we have the contribution given, right? And then we have some notes given down below. Let's first go through the notes. Included in the fixed costs are depreciation of 165,000 and 460,000 for Division C and Division E respectively. 30% of the depreciation cost in each division relates to assets controlled but not owned by the head office. Okay, so 30% of the depreciation cost in the fixed cost are controlled by the head office, right? So we have to exclude them from the calculation. Division E invested 2 million in plant and machinery at the beginning of the year, which is included in the net asset figures above, and it uses the reducing balance method to depreciate assets. Division C, which uses the straight line method, has made no significant additions to non-current assets. So this is the divisional manager who was complaining. And it is the policy of both divisions to charge a full year's depreciation in the year of acquisition. So Division E's manager would have charged full year's depreciation of 2 million at the start of the year, and they're using different depreciation methods. That's not relevant to the calculation here, but it will be relevant to the analysis we do later, because why are they using different methods? Okay, head office recharges all of its costs to the two divisions. These have been included in the fixed costs and amount to 620,000 and 700,000. And Sportsco has a cost of capital of 12%. That's relevant to the residual income calculation. So we'll start with the net profit, because a lot of things have happened in the fixed costs which are not controllable. So net profit for each of these. Net profit for the C is 1455 and for E is 3950. We need to add back. Let's start by adding the head office costs because they are not controllable. Head office costs. Okay, so for 0.2, these are 620,000. Remember, these are in thousands, so 620 here and 700 here. Okay, let's make some more space for the other. Add back non-depreciation on, right? We can make the point here on non-controllable assets. Okay, we'll set the 0 here. Let's just make that a hyphen. Okay, now how much would that depreciation be? So the fixed cost included depreciation expenses of 165,000 and 460,000 respectively. 30% of those were based on assets controlled by the head office. So 30% of 165,000, which will be 165 in this case, 30%, and 30% of 460,000, which would be this much, right? So this will give us our controllable profit. There's no other issues we need to worry about for the calculation. So 2124.5 and 4788. Again, this is a critical part of the calculation, so we'll make it bold. And then we have our ROI, return on investment. We'll put the shorthand ROI for further usage in the question in case we, so bold. And controllable profit over average net assets, we get 19.3% and 17.73%. Let's make these into percentages. Okay, and let's make these bold. So that's the first part done, the calculation of the return on investment, and we've structured it so that it's easy to follow and all the key metrics used are highlighted. Okay, let's get on with part 2, which is the analysis. So it says for 6 marks, Discuss the performance of the two divisions for the year, including the main reasons why their ROI results differ from each other, right? So these are some of the points we've been mentioning when we were going through the question. Explain the impact the difference in ROI could have on the behavior of the manager of the worst performing decision. This is a standard analysis question for ROI where one manager is manipulating the results and one is not. The one who's not manipulating it has a lower ROI. The one who is manipulating has a higher ROI, and they're getting bonuses accordingly, right? That's the usual story. Let's see if that's the case here. I believe it likely is, but in any case, let's go through it, okay? So the target ROI was 18%. What that means is Division C's manager got a bonus, Division E's manager did not get a bonus, okay? And then we'll go through why that could be possible, right? So let's start with that point. The target ROI was 18%. This means that Division C's manager got a bonus, but Division E's manager did not. Okay. Now let's see who's been doing the manipulation. So it says included in the fixed cost that depreciation is not an issue. Division E invested $2 million in plant and machinery, which included net assets, figures above, and uses a reducing balance method. Division C has not made any significant changes, and as we saw above somewhere, they mentioned that one of the managers had complained, right? Where is it? Last year, yeah, here. Last year, an investment which was expected to meet the target ROI was rejected by one of the divisional managers because it would have reduced the overall ROI. So Division C did that rejection, and because of that, they got the bonus, right? So Division C's manager refused to buy additional assets by under the pretext that it would reduce the ROI. This is true, but is a decision which goes against the interests of the overall company. Thus, he effectively got a bonus despite taking a decision not in line with the goals of the company, thereby, and here we get the buzzword, exhibiting dysfunctional behavior, which they've also used as well. Yeah. The further problem is that Division E's manager did comply and invest in new equipment. Because of this, the ROI decreased below 18%. Okay, so because of this, the ROI decreased below 18%, because as you can see, it's 17.73%. So even a small change would have made it go down, right? The issue is this resulted in him not getting a bonus, but Division C's manager did. This would demotivate Division E's manager from making the right decisions when he sees that Division C's manager got a bonus despite his dysfunctional behavior, right? So we've tied those points together, okay? Right, what else? So after that, right decision. So let's just fix the spelling here. right decisions, right? Furthermore, the points that we mentioned when we were going through the question. Division E's manager uses reducing balance to depreciate assets, whereas Division C's manager uses straight line. So there's an issue here, right? Because there's two different methods of depreciation. And as you would remember from your financial accounting courses, that reducing balance results in more depreciation, especially at the start, compared to straight line, and later on less depreciation, right? So reducing balance, because it's a new 2 million worth of equipment, that would be a huge chunk of depreciation, because all of that is charged in the year of acquisition, right? So because of that, Division E's profits would have gone down as well, because their depreciation would have increased significantly. And this is highlighted. Look at the depreciation expense for C, 165,000 versus for E, 460,000, right? So this would also have decreased his ROI. This is further exacerbated, meaning amplified, by the fact that Division E's manager uses a reducing balance depreciation method, and depreciation is charged for a full year during the year of acquisition. This has increased his depreciation expenses considerably as compared to those of Division C. This can be seen by comparing 165,000 to 460,000. This would have decreased Division E's profits and thereby the ROI. It should be pointed out that it is unfair to assess both managers by the same standard when they are using different methods of depreciation. There should be uniformity in the accounting policies and estimates used across divisions to allow for an even playing field, right? Okay, all of this will likely discourage Division E from continuing to make the right decisions, and there is a risk that he too will start behaving like Division C's manager in order to get a bonus, right? Okay, so yeah, we've summed up the major points and 6 marks worth of analysis. We've covered that. Okay, after that, let's move on to the second part, part B, part 1. So part B, part 1. Okay, let's make this bold. Calculate the residual income for each of the 2 divisions for SportsGo and briefly comment on the results of this performance measure. So residual income, what was the formula? First, let's just copy the headings and everything before we get into that. So we have Division C and Division E. The formula was controllable profit, which we'll take from up here, copy and paste. Okay, we'll have to once again reset the formula is equal to this and this. I didn't want to paste as values because then it will just be the numbers directly. I wanted to link the formula. Controllable profit minus imputed interest, less imputed interest. And what is imputed interest? That is the cost of capital into capital employed. So the cost of capital given was 12%. So we'll just mention that at cost of capital of 12%. Okay, so this will be 12% into the capital employed. Once again, the average capital employed, because they mentioned that so they mentioned in the question, right? Like ROI, this would be calculated using controllable profit and average divisional net assets. So into average divisional net assets. Okay, so we have these two amounts. Let's put a minus sign there as well to indicate the less part. Okay, so that will give us our residual income. We'll make this bold as well. So we add these two up, 804.5 and 1548. Okay, so that's the calculation, and they say briefly comment on the results of this performance measure. So briefly comment. For residual income, it's always about whether it's good or bad. Residual income, if it's positive, it's good. If it's negative, it's bad. So let's mention that. The residual income for both divisions is positive. This indicates that they are both performing well and making a return of higher than their cost of capital of 12%. Okay, yeah, no need to make these bold as well. Okay, so we've made our brief comment and we can move on, but please remember to make the brief comment if they ask for in the requirements, right? They didn't ask for in the first requirement, but they did in the second one. Okay, part 2, explain the advantages and disadvantages of using residual income to measure divisional performance. So these can easily be covered, standard advantages, disadvantages, which we covered in our videos as well. So let's make a heading for advantages and let's make a heading for disadvantages. Okay, so advantages, what are the advantages of using ROI? First, it's an absolute measure. So it gives you how much value is actually added to the business in magnitude, right? That this is how much profit the business made after paying off everyone, 804.5 and 1548, which the ROI, for example, does not. It just gives you a percentage. It doesn't tell you how much actual absolute value is being added to the business. So that's the first point. Number 1, the residual income gives is an absolute metric and gives an idea of the actual magnitude of value, let's add some more rows, being added to the business. It shows us exactly how much income was made after all costs were paid to the relevant parties, thereby showing how much the business increased in value by. Okay. Number 2, a simpler advantage which we can give. It's very simple and easy to calculate, right? The residual income, residual income is very simple and easy to calculate. It requires no benchmark because we're not comparing it to no benchmark. So it's very simple and easy to calculate and assess. That's what our point should be. It requires no benchmark. Simply put a positive value is good and negative value is bad. Okay, so we have our 2 advantages. Now why just 2? Because it's 4 marks, right? So ideally let's just split, that means 4 points, so let's split up into 2 advantages and 2 disadvantages. You don't necessarily have to follow that technique, but that's more or less the standard, right? If you want, you could add more, but if it's for 4 marks, the marker will generally just read the first 4 and not go any further. So even if you do add 4 because they haven't specified a number, make sure the first 4 you add are your best ones, because the marker might not even read the next ones, right? Disadvantages. First one, always, like we said, for accounting based metrics like the ROI, like the residual income, they can easily be manipulated, as we've seen in this question. So the residual income is calculated based on accounting numbers which can easily be manipulated, as was the case in the above scenario. Okay, and number 2, what's another disadvantage is the absolute part, right? Yes, it tells us how much value is being added, but on the flip side, it doesn't allow for comparison between the scale of companies, right? So just to indicate what I'm saying, Division C had a lower residual income than Division E by nearly half. But if you compare the size, Division C has a size of around 11,000 on average, if I remember correct, 11,000 on average, whereas Division E has a size of 27,000. It's nearly 3 times as big as Division C. So naturally it's going to make more of a profit, right? Google is going to make more of a profit than a small software house because Google's much larger in size. That doesn't necessarily mean it's a better performer or more efficient. It just means it's larger in size. But residual income does not indicate that or allow us that comparison. Residual income is not good for comparison purposes as it ignores the scale of operations. To illustrate, Division E has a residual income of nearly twice the amount of Division C. However, it is also more than twice the size of Division C as per the average net assets. However, residual income will not make this apparent, and a larger division will usually have a larger residual income just by virtue of its size. Okay, so there we have it. 2 advantages, 2 disadvantages, 4 marks were covered. We're good to go. Okay, so yeah, that's the standard questions for divisional performance measures. Like I said, we covered the calculation for residual income, we covered it for return on investment, we covered the analysis for return on investment, which is a typical question for part C, and we even covered the advantages, disadvantages, which are once again common for these types of topics. Okay, so I hope you guys benefited from this, and I'll see you guys next time.